Valor Energy Incorporated, formerly Senmiao Technology Limited, is undergoing a dramatic strategic transformation from a small China-focused automobile services company into a U.S.-focused energy and digital infrastructure development platform. The company's new strategy centers on power-enabled infrastructure designed to support artificial intelligence and high-performance computing data centers. The name change became effective on NASDAQ on August 26, 2026. This makes Valor Energy a highly speculative transformation story, where the future opportunity is potentially much larger than the company's historical operating business. The investment thesis for Valor Energy is not based on its historical revenue or earnings. Instead, the opportunity depends on whether management can successfully build a new business around U.S. energy infrastructure and AI data centers. Artificial intelligence is creating enormous demand for reliable electricity, data center capacity, and energy infrastructure. If Valor can secure power, land, financing, and customers, its valuation could eventually be based on infrastructure assets rather than its legacy business. However, the company remains at a very early development stage, making the investment highly speculative. The most important development is the proposed Energence Utah partnership. Under the announced plan, Valor Energy would make a staged $5 million development capital investment into Energence Utah, LLC. The project is located within a planned 5,004 6-acre integrated energy and industrial development in Duchesne County, Utah. The proposed development is designed to combine energy generation, storage, transmission infrastructure, and AI-oriented data center capacity. The $5 million should not be viewed as the total construction budget because developing a large power and data center campus could ultimately require hundreds of millions or even billions of dollars. The initial development target is approximately 100 megawatts of firm power capacity during the first 2 years. The proposed energy mix includes natural gas generation, solar photovoltaic generation, and battery storage. Reaching the 100 megawatt target would be an important validation milestone because it would demonstrate that Valor is moving from an announced strategy toward actual energy infrastructure. However, this target depends on engineering, permitting, financing, interconnection, equipment procurement, and commercial agreements. Investors should therefore treat 100 megawatts as a development objective rather than guaranteed capacity. The long-term opportunity is significantly larger. The Energence Utah plan targets approximately 700 megawatts of firm capacity by year 4, and potentially as much as 1.2 gigawatts of firm capacity by year 6, with approximately 1.9 gigawatts of total connected capacity. If these targets are achieved, the project could become substantially more valuable than the company's historical business. The important point is that these figures represent development potential, not current revenue-producing assets. The market will eventually require evidence that the company can convert these targets into financed and operating infrastructure. The strongest part of the Valor Energy thesis is the broader AI infrastructure trend. Artificial intelligence requires massive computing power, and large computing facilities require enormous amounts of electricity. As AI workloads expand, access to reliable power, suitable land, and transmission infrastructure is becoming increasingly important. This creates an opportunity for companies that can develop power-enabled sites specifically designed for data centers. Valor is attempting to position itself within this growing market by combining energy development with digital infrastructure. Valor's historical financial performance demonstrates why this remains a speculative investment. For fiscal 2026, the legacy company generated approximately $1.55 million of revenue, compared with approximately $1.90 million in fiscal 2025. Gross profit declined to approximately $210,000 from approximately $572,000. More importantly, the company reported a net loss of approximately $5.37 million for fiscal 2026, including approximately $5.27 million attributable to company stockholders. These numbers show that Valor has not yet demonstrated the financial strength of an established energy or infrastructure company. Capital requirements are one of the biggest risks facing Valor Energy. The proposed $5 million of development capital may help advance the project. but it is nowhere near enough to construct a large-scale power and AI data center campus. The company could therefore require project financing, strategic partners, debt, and additional equity capital. According to the fiscal 2026 filing, approximately 14.56 million common shares were outstanding as of June 26, 2026. If significant additional equity is issued, existing shareholders could experience substantial dilution. For this reason, investors should monitor the fully diluted share count very closely. I would treat 2026 primarily as a transition and development year rather than a commercialization year. My estimated revenue range is approximately $1.5 million to $2 million because the new energy and digital infrastructure strategy is not yet expected to generate significant operating revenue. The historical business provides limited visibility into the future because the company's business model is changing. Consequently, 2026 earnings are less important than financing, project development, and strategic execution. For 2027, my base case revenue estimate is approximately $5 million to $10 million. This forecast has a very wide confidence range because Valor does not yet have significant recurring revenue from the new infrastructure strategy. My base case 2027 EPS estimate remains negative at approximately negative $0.30 to negative $0.60 per share. Development expenses, financing costs, and corporate overhead could continue to pressure earnings. A successful infrastructure commercialization could eventually create a much stronger earnings profile, but that outcome is not yet sufficiently visible. In the bull case, Valor successfully completes the Energence transaction, secures financing, advances the initial 100-megawatt project, obtains data center customers, and develops additional U.S. energy projects. Under this scenario, revenue could eventually move into the tens of millions of dollars as the company begins monetizing infrastructure development and project-level interests. More importantly, investors could begin valuing Valor based on its infrastructure pipeline and future cash-generating assets rather than its historical automobile business. The base case assumes meaningful progress but slower commercialization. Valor advances the Energence Utah project, but large-scale construction and customer commitments take longer than expected. Revenue grows gradually while losses continue, and the company requires additional financing. Under this scenario, the stock could retain significant speculative value because of its infrastructure pipeline, but investors would continue applying a large discount because of execution risk, financing requirements, and the lack of established cash flow. The bear case assumes that the proposed projects experience significant delays or fail to reach commercial development. Financing could become difficult, permits or interconnection could take longer than expected, or customer commitments may not materialize. In addition, substantial equity financing could create heavy dilution. Under this scenario, Valor could remain a small loss-making company with limited revenue, causing the stock to trade significantly below its speculative valuation. A traditional discounted cash flow valuation is currently difficult because there is insufficient visibility into long-term revenue, margins, capital expenditures, and free cash flow. Instead, I would use a probability-weighted development valuation. The market should assign value based on the probability that Valor successfully converts its development pipeline into operating infrastructure. Therefore, valuation should increase as the company obtains financing, permits, power agreements, customers, and construction milestones. My 2027 scenario framework is approximately bear case, $0.50 to $1.00, base case, $2.00 to $3.00, and bull case, $4.00 to $7.00. My central base case target is approximately $2.50 per share. These are scenario-based estimates rather than official analyst targets. The valuation could change dramatically as the company provides evidence of financing, power commitments, data center customers, and actual project development. The most important catalysts include closing the Energence Utah transaction, completing the staged $5 million investment, securing project financing, obtaining power and interconnection agreements, signing data center customers, and reaching construction milestones. Additional U.S. project acquisitions could also significantly expand the investment thesis. Importantly, actual contracts and financing commitments would be much more meaningful than additional strategic announcements without financial or operational backing. The major risks include equity dilution, project financing, permitting delays, interconnection problems, construction cost inflation, customer concentration, technology changes, and competition from much larger infrastructure companies. There is also a valuation risk because investors may assign value to announced development projects before those projects generate meaningful cash flow. The difference between potential infrastructure value and actual operating assets is one of the most important risks investors should understand. There are 5 critical indicators to monitor. First is the company's cash position and financing capacity. Second is the fully diluted share count. Third is progress toward the initial 100 megawatt power target. Fourth is the number and quality of signed data center or power customers. Fifth is actual revenue and operating cash flow generated by the new business. If all 5 indicators improve simultaneously, the fundamental investment thesis becomes considerably stronger. Valor Energy should not yet be viewed as a conventional energy company. It is better classified as a high-risk digital infrastructure development company with an energy strategy. The AI power opportunity is attractive, and the Energence Utah project provides a potentially important starting point. However, the company currently has very limited revenue, significant losses, and substantial future capital requirements. The potential upside is therefore large, but investors must accept the possibility of significant dilution and project failure. My 2026-2027 rating for Valor Energy is speculative hold, high-risk speculative buy for investors who understand the risks, rather than a conventional buy. My central 2027 price target is $2.50, with a bear case of $0.50 to $1.00 and a bull case of $4.00 to $7.00. The bullish thesis is that Valor successfully transforms itself into a power-enabled AI infrastructure platform and eventually controls or participates in valuable energy and data center assets. The bearish thesis is that financing, dilution, permitting, or execution problems prevent the company from turning its development pipeline into real cash-generating infrastructure. For 2026, investors should focus on financing, permits, interconnection, and contracts. For 2027, the key question is whether those developments translate into actual revenue, assets, and cash flow. Until that happens, Valor Energy remains a high-risk, high-reward speculative investment, rather than a proven fundamental compounder.